will come back to help her dad. Retiring early through dividend investing is indeed a viable path to financial independence, with the main goal being to build a passive income stream sufficient to cover your living expenses. The key benefits here are financial freedom, time autonomy, and the compounding of wealth. Let's get into the basics. Dividends are a portion of a company's profits distributed to its shareholders, typically paid quarterly, monthly, or annually, and can be reinvested to buy more shares through a DRIP or dividend reinvestment plan. The dividend yield is the annual dividend payment divided by the stock price, and it's used to compare dividend returns across different companies. Remember, though, that a higher yield isn't always better and requires further research. Different types of dividend stocks include blue-chip stocks, which are established, stable companies with consistent dividends, REITs, or real estate investment trusts, which pay out a significant portion of income as dividends, MLPs, or master limited partnerships, often found in the energy sector and offer high yields, but come with tax implications, and growth stocks that also pay dividends, offering a combination of growth potential and income. Building your dividend portfolio. Setting realistic goals is essential. Calculate your annual expenses needed in retirement, determine the target dividend income required to cover those expenses, and estimate the portfolio size needed based on the average dividend yield. Your investment strategy should include diversification, spreading investments across different sectors and companies, dollar cost averaging, which is investing a fixed amount regularly, regardless of price, and, of course, dividend reinvestment, automatically reinvesting dividends to buy more shares. When choosing the right stocks, look for financial stability, consistent dividend payments and growth, a healthy payout ratio, where lower is generally better, and a thorough understanding of the company's industry. You can hold these investments in either a taxable brokerage account for general investing, or tax-advantaged accounts like Roth or traditional IRAs to maximize tax benefits for retirement. ETs talk about figuring out your retire early number. Start by creating a detailed breakdown of your living expenses, accounting for inflation and potential future costs. Then determine your target dividend income, which is your annual expenses less any other sources of income, like Social Security. Your portfolio size can be calculated by dividing your target dividend income by your average dividend yield. For example, if you need $50,000 of income and your portfolio yields 4%, you'll need a $1,250,000 portfolio. Finally, estimate the time needed to reach your portfolio size based on your savings rate and investment returns, and use online calculators to project your portfolio growth. Key metrics to track and analyze in your dividend portfolio include the dividend payout ratio, which indicates dividend sustainability, where lower is generally safer, and should be tracked over time. You'll also want to monitor the dividend growth rate, which is essential for keeping up with inflation, looking for consistent growth over several years. The portfolio yield, which is the overall yield of your dividend portfolio, should be monitored for changes that indicate potential problems. And finally, keep an eye on the debt-to-equity ratio, which measures financial leverage. It's best to avoid companies with excessive debt. Common mistakes to avoid when dividend investing include chasing high yields, as unsustainable yields can indicate financial problems. So focus on quality over quantity. Avoid a lack of diversification by spreading investments across different stocks and sectors to reduce risk. Ignoring taxes is another mistake since dividends are taxable income unless held in a tax-advantaged account, and you should understand the tax implications of your investments. Emotional investing should be avoided by sticking to your strategy and not making rash decisions based on market fluctuations. And finally, don't forget to reinvest those dividends, as it's a missed opportunity to accelerate compounding. Stay the course and maintain your portfolio. Conduct regular portfolio reviews to rebalance and maintain diversification, and assess dividend payout ratios and the financial health of your holdings. Be prepared to adapt to market changes as needed, staying informed about economic trends and industry news. Remember that dividend investing is a marathon, not a sprint, so patience and discipline are key to success. In conclusion, retiring early on dividends is achievable with careful planning and execution. The key is to focus on building a diversified portfolio of high-quality dividend stocks. Start investing today and take control of your financial future, and consider speaking to a financial advisor to get started. Thanks for watching. See you next time on Helper Dad.